David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. This is the fourth of a continuing series of podcasts that we will host on an ongoing basis. For the time being, the goal is to produce these podcasts on a weekly basis. As the COVID-19 situation remains fluid, ultimately we'll move to a monthly schedule. Through these podcasts, we will continue our observation of the economic impact of the response to the virus, and we'll continue to share our thoughts on current market conditions, as well as the opinions of the many economists and analysts and managers that we follow on a routine basis. Now, please feel free to share the link to these podcasts with anyone that you feel may also benefit from having the information that we are disseminating through this channel. So as usual, let's begin with a market overview. And we're recording this intraday on Thursday, the 7th of May. So right now, as we're recording this, the Dow Jones Industrial Average is higher by 370 points and stands with a value of 24,030. Remember that the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March, and then it had a value of 18,213 points. Again, only time will tell if this proves to be the market low for the event. Conversely, the previous market high was established on the 10th of February with a value of 29,379 points. From the February high water mark to the most recent intraday low on the 23rd of March, the Dow Jones Industrial Average was down by 11,338 points, or 38%. And we talked about the worst case assumptions that the market priced into itself during that cathartic decline. Since that low point, as of the time of this recording on the 7th of May, the market is higher by 5,817 points, for a gain of 31.94% from the March intraday low. We remain off of the high levels, though, by 5,521 points, or 18.68%. Within the last two podcasts, we talked a lot about the energy sector. It was really an odd thing to watch the May delivery contract close at nearly negative $40 per barrel. But then it was equally odd to watch that same contract close with a positive $14 the very next day. Many of you have asked, what's going on with energy? Clearly, there's unprecedented volatility. Over the last week, though, we have observed a stabilization in the energy complex and really some good strength. So that's a good sign. Reviewing the futures contracts for oil on the website of the CME Group, oil is trading in the high 20s to mid $30 per barrel ranges well into next year, 2021. In my opinion, and in the opinion of many of the economists that I've read lately, the energy market seems to be sending a signal that it anticipates the return of demand as the economy recovers and strengthens from the COVID-19 induced shutdown. Otherwise, I would expect to see weakness in prices far into the future, but we don't. So that's a good sign, but it's just one data point. One data point does not a trend make. So what other things can we observe? Routinely, I'm keep an eye on a basket of credit spreads. There's a lot of them out there. What is a credit spread? And I'll just give you a working definition here so that you'll have an understanding of why this is important. A credit spread is the difference in yield, for example, between two bonds of similar maturity but different credit quality. So for example, if you had a 10-year Treasury note and it was trading with a yield of 6% and a 10-year corporate bond trading with a yield of 8%, the corporate bond is said to offer a 200 basis point spread over the Treasury. So that seems simple enough. But what it tells you is this: a widening credit spread indicates growing concern about the ability of corporate or other private borrowers to service their debt. Now, on the other hand, narrowing or tightening credit spreads indicate improving private credit worthiness. All right, so I gave you that definition just as a backdrop behind why an environment of tightening credit spreads might also be a good forward indicator of economic strength ahead. Said another way, what signals might the debt market be sending us about the potential for economic recovery and strength? All right, so here you see a graphic. This graphic was obtained from the St. Louis Federal Reserve Bank website. You'll see the most current TED spread. The TED spread is simply the difference between the 3-month Treasury bill and the 3-month LIBOR based in US dollars. To put it another way, the TED spread is the difference between the interest rate on short-term US government debt and the interest rate on interbank loans. A wide TED spread normally indicates a period of economic crisis. Conversely, a tightening spread normally indicates strong or improving economic conditions. All right, clearly, the TED spread spiked at 142 basis points on the 27th of March. And let me give you some relative context. The highest that I have ever seen it was 183 basis points in October of 2008 as we were getting into the Great Recession. So obviously that caught my attention. But as of the 28th of April, just a few days ago, 1 month later, the spread stood at 65 basis points. Now, yeah, that's higher than the 30 basis point average that we normally observe, but look at how that spread has tightened in a relatively short period of time. This is a good, positive, forward indicator signal of what the debt market believes to be in store for the U.S. economy. So we're beginning to see these positive indicators daisy chaining together. All right, right now we've got the stock market that is somewhere between the fourth quarter of this year and the first quarter. We've got the energy sector, and now we've got credit spreads. These are good discounting mechanisms. They're forward-looking into where we may be going over the next several months. So let's look at economic data over the next 30 days. Since our last podcast, Congress has approved over $484 billion in a second wave of funding for the CARES Act. That brought a cumulative $660 billion into the hands of employers having fewer than 500 employees to continue salaries and bridge the economic gap of the COVID-19 shutdown. Now, as we've discussed, we are really only now at a point where the impact of the payroll protection plan can begin to be measured. Today, we learned that initial jobless claims were 3.169 million for the week ending on the 2nd of May. Now, I suggested 2 weeks ago that weekly jobless claims would likely begin to decline sharply as the impact of the PPP could be measured. And I believe we're seeing exactly that. Today's report is 54% lower than the high for such claims of 6.86 million just 5 weeks ago. The biggest surprise in today's report was the fact that the 4-week moving jobless claims average dropped by 861,500 payrolls. Last week, we noticed that the 4-week moving average dropped by 577,000 claims. So this is indeed a very positive trend, and hopefully it continues to gather momentum. So let's be real for just a minute. There is absolutely no question in my mind that the Labor Department report that we will receive on Friday the 8th will be historically abysmal. My guess is that we'll probably hear about over 20 million payrolls lost for the previous reporting period and an unemployment rate of 16% or higher. Remember, big asterisk here, this report covers the survey period between the 12th of March and the 12th of April, and it was during this time when we saw most of the efforts to close restaurants and businesses that were deemed to be non-essential. It also included the period of time prior to the passage of the CARES Act and before the PPP program. Employers were faced with few other options than to simply lay off employees. So, look, don't be surprised if the market is higher tomorrow as these bad economic reports are made public. In my opinion, the market has long since priced this into itself. Okay, the market isn't here. The market is quarters down the road and is now discounting the balance of the year and how it may unfold. Remember, markets are discounting mechanisms in both directions. Now, conversely, I believe that the Labor Department report that we have on the 5th of June could look very positive and in stark contrast to the report that we get tomorrow on the 8th of May. Also, I believe that workers that have been previously laid off will continue to be recategorized as being furloughed with pay, and thus we may see positive revisions to the previously historically bad reports, and that's very, very possible that a good bit of the improvement in the 4-week moving jobless claims average is attributable to this alone. So just keep that in mind. Reopening the economy. As I've stated before, I believe that we have seen the apex of COVID-19 in this country. Each state is observing their own curves, but on the whole, I believe that the data confirms that we are on the downslope of this bell curve. Now, here you're looking at an image of a text that Brian Westbury, a tweet that he released a little over a week ago. There's been a lot of talk lately about how we need more and more testing before we can even think about reopening the economy. Awesome. On the 26th of April, Brian Westbury noted that between the 17th and 21st of April, there were 151,000 people tested on an average daily basis in the U.S., with an average positive rate of 18.1%. Over the following 5 days, from the 22nd through the 26th of April, we tested an average of 257,000 persons per day with an average positive rate of 12.8%. It would seem that the more we test, the percentage of positive results decline, and that's an extremely good trend. As of this podcast, there are 24 states that have reopened to some extent, and another 4 states to potentially reopen by this weekend. And you see a graphic here of those states. Of the 22 states left to reopen, it is speculated that 2/3 of those states could meet the criteria for a phase 1 level opening by the end of this month. I believe that we are within a critical 60 to 90 day window of time. What we do or don't do over this period of time will determine how robust or how weak economic conditions may be in the fourth quarter of this year and the first quarter of next year. Now, in my opinion, and in the opinion of virtually every economist that I've followed in recent weeks, the faster that we can safely reopen the country, the more likely it will be that we have much stronger economic conditions later in the year. Now, here's why I think that's important. Now you see an image of a bridge. Okay, I want you to think of this bridge span as being the capacity of the CARES Act to span the COVID-19 economic disruption and preserve spending momentum across this gap of time. Now remember, from previous conference calls and podcasts, we talked about the 18 economic metrics that as of mid-February were at strongest readings ever recorded or near highs not seen in some cases for 30 years. The question is, can we preserve that momentum across this gap of time when the economy was curtailed? All right, look, we can't continue to print money with never-ending legislative acts. In my opinion, we do have enough in the CARES Act to span the gap as it stands now. If the eastern shore of that chasm widens, however, then the bridge isn't long enough to span the gap. If the economy hasn't reopened to a meaningful degree by September, then we will likely find ourselves with long-lasting economic damage from which it may take years to recover. If we are largely reopened over the course of the next several weeks, however, I think we may see some of the best quarterly economic metrics we've ever seen in the U.S. What does or doesn't happen over the next 60 to 90 days will likely determine which of those outcomes we will eventually have. Now, last week we talked about how the advance read on first quarter GDP was down 4.8% against expectations of a decline of 4%. So look, again, I believe that the market has moved way past this point. So to me, it's a red herring. The reports that we will observe over the coming months will be the ones that are most telling. And estimates vary widely as to the severity of the economic contraction. So as we'll discuss in later, as we move forward toward reopening the economy, those efforts are critical to the chances that we might see a short-lived contraction and a robust economic recovery in the fourth quarter. Lastly on this topic, you've heard me talk about things that I can quantify and being driven by things that I can quantify. And in that conversation, you've heard me refer to the Chinese manufacturing output as measured by the Market Flash PMI Index. Right now, I'm not so inclined to believe things coming directly out of China, but I am inclined to believe things that are observed outside looking into China. And as far as this industrial index is concerned, look, you're either making widgets or you're not. So it is a matter of counting industrial output. It's not something that can just be fudged or fabricated. Every country has a PMI index. Readings above 50 indicate expansion. Readings below 50 indicate contraction. Last week, we observed that the February reading, last week we talked about how the February reading for Chinese manufacturing output stood at 35.7, and that was an abysmally low reading. The following month, on the 31st of March, we learned that reading had recovered to 52. I have never seen a manufacturing PMI index jump that far that fast. And the only way it could have is if healthy workers were actually back in the factories making widgets. That's the only way that could have happened. But now that's just one data point. On the 30th of April, we observed that reading at 49.4. Okay, well, while that number remains just off what we would call expansion territory, it is still sharply higher than the reading that we had just 2 months ago. And it's indicative of the sustained resurgence of manufacturing activity in the COVID-19 epicenter country. Now remember, the markets had initially assumed a lot in terms of worst-case scenarios within low valuations just a few months ago. This is the kind of evidence of actual results being much better than the worst-case assumptions, and that's probably what's behind this 31% rally from the March 23rd intraday low. Understand this too. This is a backward-looking reading. Those workers in the Chinese factories not only had to be there for the last 60 days, but they also had to be there and healthy. Well, if you will look at your Worldometer site under China, you will not see a corresponding second wave of COVID-19. So anecdotally, it would appear anyway in China that it is indeed possible to return quickly to and see a surge in manufacturing activity for an extended period of time without triggering a second wave of COVID-19. We're about to get into those reports for the Eurozone, where we saw Sweden that never closed. We've observed soft opening in Italy, France, Spain, Germany, the United Kingdom. We will observe their PMI readings over the coming 30 days. And from those two regions of the world, we'll get a good idea of what we might expect here over the coming 60 days. It is critically important to observe the dispassionate metrics and separate yourself from the incendiary sensationalism of the media. Please do that. COVID-19 update. Again, I'm going to touch on it because it's important. I will say this, as of this morning, we have 1,273,406 reported cases in the U.S., and of those, 984,254 remain open. So again, not citing not only Worldometers, but also the World Health Organization and the CDC, it appears that the recovery rate is now over 97% for those not in a high-risk group. It is interesting to note that just last month, according to Worldometers, recoveries in the United States have risen from 37 to 213,326. Last week when we were doing this podcast, that number stood at around 147,000. So look, you do the math. The slope of that line is pretty steep, and it's the strongest of any of the COVID-19 trend lines on the Worldometer site. Over the last couple of podcasts, we've talked about Gilead Sciences. They've been in the news because of 2 positive tests regarding their drug remdesivir. It has since been fast-tracked by the FDA for use. In one study, the National Institute of Allergy and Infectious Diseases concluded that the drug met the primary endpoint of the study, and that patients recovered much more quickly than those treated with a placebo, and the numbers were 15 to 11 days. I mean, that's almost a 25% improvement in the rates of recovery of patients treated with that drug. The markets had been moving higher since the 24th of March, in part because worst-case assumptions that were priced into the cathartic reaction back in February are not proving to be the results that we're observing. As we've discussed within conference calls, markets are discounting mechanisms and in both directions, and now markets are in the process of repricing the assumptions that were made about 3 months ago in light of currently available information. Now, 2 weeks ago, we were discussing studies from Stanford and USC and Massachusetts that suggested actual rates of infection could be 50% higher than what we have observed through testing. That there were maybe a number of asymptomatic people, more so than we thought, that they're finding through random samples, who had tested positive for antibodies. So the conclusion of those studies are being that herd immunity could be vastly higher than any model anticipated months ago. Months ago, we were dealing with models that projected a 2.2 million rate of death. Those models have since been revised down 95%. The CDC over the weekend actually cut their death count by almost 50%. Go to their website and look at that. So the worst case numbers that we saw 3 months ago are not panning out to be the things that we are actually observing right now, and the markets are simply in the process of going back and repricing those assumptions. So in conclusion, folks, stay focused on where we're going. And that means a lot of stuff, by the way. That means insulating yourself against rhetoric and against sensationalism and politically driven media bias. Separate yourself from that. Stay focused on what you can quantify. Separate yourself from sensationalism. You cannot react to a shocked market. If you try to do so, it generally historically, it's created a larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, then make this crisis work for you. And for what it's worth, over the last couple of weeks, I have researched 16 other periods of time across my 29-year career when markets reacted to acute shocks. Acute just meaning it came out of nowhere, it was sudden. Some of the shocks were mild, some of them were pretty deep. And I've suggested to you that while the nature of the shock may be different, some of you have questioned me, well, David, all of these shocks, this time it's different. Well, they're all different. The nature of all of these shocks is different, but the reaction to the shock typically follows a familiar pattern. And indeed, what I found is that 15 of those 16 shock periods of time that I observed, the markets reacted in essentially the same manner. Reaction followed by capitulation, followed by recovery. The period of time might have been different. The spikes and the peaks and the valleys may have been different, but the pattern is the same. The only shock that didn't follow this pattern was 9/11, and that was because it occurred on the heels of a Y2K-induced recession. This shocked market, at least so far, is following the same pattern of 15 of the last 16 recoveries. Patience is the key. Stay focused on where we're going, not where we are. Lastly, we're having Zoom video meetings, intercall conference call meetings, individual phone meetings, as we remain unable to have face-to-face meetings, and hopefully that changes in the near future. But in the meantime, we are trying to feverishly stay in touch with all of you, in mass and individually. Never hesitate to reach out to us with your questions and needs of clarity. This podcast, virtual meeting technology, social media, other channels, it's just part of a multifaceted approach that we've employed as an effort to lead in this crisis in a very visible manner. We are committed to getting through this together, and of that much I can assure you. Thank you again for your attention to this. Please share this with whomever you feel may benefit from it, and we will have another podcast this time next week. Happy weekend. Stay safe.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.